everyone.
Good morning, everybody. Well, welcome and thank you. It looks like we're having a bit of technology issues with my video camera, and that's probably a good thing. You don't need to see me this morning. Well, welcome and thank you for attending our second session. For those who came last week and tuned in, we spoke about the importance of staying seated and not making emotional decisions around your money. And you can only do that when you're confident with the underlying investments. So our topic today is your portfolios and why they are perfectly engineered for these significant events. Now, we have 4 sessions this week. This is the first one this afternoon at 5:30, Thursday at 9:30, and Thursday afternoon again at 5:30. So it's all the same content with just different partners and advisors going through the information. So feel free to log in again if you would like to. For those who missed out last week, we did record it, as we are recording this one this week. So this afternoon we'll be sending out a link for those who would like to watch the first session again, or pass it on to friends or family, and we'll send a link out from this week as well, probably next Wednesday. Teneale.
Excellent. Well, first of all, we hope you're all staying safe and staying well. My name's Teneale. I'm one of the partners and financial advisors with Alman Partners. Oh, look, we can see Steve's handsome face now. Now, first of all, we certainly know that these are very trying times that we're all going through, and our thoughts are with you and your family. Now, if you do need any assistance or advice, we're still 100% operational, so feel free to contact us on our normal phone numbers, email, reach out, and we'll help out in any way that we can.
Great, and we have questions and answers, I think, Teneale.
We do. So down the bottom there, you'll see a question and answer section. If you'd have any questions that you've got, please feel free to put them in down there. Do note that anything that you put in is not viewable by any of the other attendees. So feel free to do so, and we'll try and answer those at the end. Okay, now first of all, I will just go through a bit of a disclaimer that any information we present today is general in nature. So if you are looking to make any investment decisions, do make sure that you speak to a financial advisor before doing so. And if you don't have a financial advisor, please feel free to reach out to us. Now, we do already have a question, so I'll look to answer that one at the end. Now, let's kick it off with a bit of a quick market overview. Certainly, if we look back over the last 12 months of the 2019 year, January through to December, this slide here shows that we did have a stellar year in markets. Here you can see 3 of the indices. So we've got the All Ords Index up the top there, which is the top 500 companies on the Australian Stock Exchange. Now, they had returns of 24% in that period. Next along the line, we've got the S&P 500 index, which is again the top 500 shares on the US stock markets. And then at the bottom, you can see the MSCI, which is the whole of world index, capturing 22 of the 23 developed markets, excluding Australia. So very positive returns all around globally there. Now, we know that's not the whole story though, and if we take a bit of a look now, we can see that from January to March this year, we've had certainly quite an extreme amount of volatility, and we can see that depicted with those same 3 indices and negative returns that's been seen there. We do know that there's volatility for some time to come. We don't know how long that will be, but remember back to last week for anybody that did join us, one thing we do know is that we don't know when to get out of markets and back in. And timing markets is near impossible. But the positive is if we have a look at that whole 15-month period, so January 2019 through until March 2020, we can see that really markets have just gotten back to the point that they were at back in January last year. So whilst it might have felt a lot more emotional to go through that period, really that's just bringing us back to the position of where we were January last year. Over to you, Steve.
Thanks, Teneale. I forgot to mention before, we'll probably go for about 15 minutes today. We've got a few questions coming in, so that's fantastic. So we're talking about engineering your portfolio. So we're going to dig into, I guess, our value proposition to our clients is that you'll have confidence and peace of mind when we do go through turmoil in world markets. And hopefully the information that we shared last week and the information we share today just builds that confidence, so you're not getting caught up in all of that noise that's out there at the moment, which can scare the most sophisticated investor. So let's talk about the first thing we do for you, and that is building your asset allocation. And so when we look at this chart here, we're talking about, I guess, allocating your capital to appropriate markets for your goals, your time horizon, and your stage of life. So let's have a look at the top there. You've got AP 50/50, AP 100/0. So the first numbers are how much assets are in the growth part of the portfolio, and then following on from that is the defensive assets. So on the left-hand side, you'll see defensive, fixed interest, and then under the growth, you'll see Australian equities, global, and property. And as you go across, you'll see the allocation of those. So let's look at the AP 100/0. So nil fixed interest, 55% of the assets in Australian equities, 40% in global equities, and 5% in property trusts. Now, obviously, that's a fairly aggressive portfolio, and that would be ideal for our clients who are, under 45 years of age, accumulating their assets, got plenty of time in front of them to ride out market volatility. Over to you, Teneale.
Yeah. Well, certainly then we know that that's not the whole picture. So if we move a little further to the left now and talk about the AP 50/50 portfolio, or even the 70/30 portfolio, you can see the real difference here is that there's some fixed interest or some defensive assets in these portfolios. And their job is to really dampen the level of volatility, so the ups and the downs that any portfolio will experience. And it also provides some high quality income producing assets. Now, this portion of the portfolio is really seen as that income bucket, and it's generally where our retirees will land when it comes time to start drawing an income stream from their portfolios, and when we want to stop that level of volatility that's being experienced or dampen that further. We do call this a glide path strategy. So what we tend to do for our clients over their lifetime that we work together is to start to glide path them down from those higher levels of growth assets earlier on, as you said, if they're accumulating, and then down into that area where there's more of that fixed interest bucket from up to 5 to 10 years before retirement.
Yeah, thanks, Teneale. Well, folks, this is a really important part of what we do. Academic research shows us that getting these decisions right, where to start and where to end, there was a study over a 10-year period in the States on pension funds, and they found that they could attribute 90% of the success of a portfolio by getting these decisions right. And we've been through these things before, and particularly for our retiree clients, that can be very, very challenging. But if you're a retiree and you're in our AP 50/50 portfolio or 70/30, you've got an enormous amount of your assets in defensive buckets, if you like, and Teneale's going to explain how that works for you. But needless to say, many of our clients who went through the GFC didn't really need to dig into their growth assets because they had a good allocation to defensive assets. So you'll enjoy that part of the presentation towards the end. Now let's look at our portfolios then over the last 3 months and look at what's happened. And you can see quite clearly at the bottom of the ladder there is our most aggressive model portfolio, and it's fallen pretty well in line with markets. And as you start climbing the ladder, you can see the more defensive assets coming in, reducing that volatility, and of course then reducing the falls in markets. It should be said also though, conversely, when markets are rising, you're not going to get as much growth, but it's all about managing volatility for you when you're in the drawdown phase.
Absolutely, and it's why when we're seeing on the news, on the media, that markets are plummeting, they might be talking about that. It's important to note that for the majority of our clients' portfolios, they're not invested that way because they're talking 100% about a share market or a set of indices there. So next we're going to have a bit of a talk about, should I be worried about my growth assets? In this area, we'll talk a little bit about how we protect share portfolios, firstly starting out with the basic engineering of the construction of those share portfolios. We know that if we take a look on the left-hand side here, this shows quite a concentrated portfolio, and certainly not having a lot of protection there against market conditions. Now, Alman Partners believes that we should work with markets and not against those, and we know for the majority of people who try to beat markets by stock picking and market timing that they will fail. So we believe in what's called asset class investing, and simply put, that means broad diversification across the whole market and having a focus on those low costs. Now, in this concentrated portfolio at times like this, it's kind of like driving, a Ford Fiesta right into a light pole at 80 kilometers an hour. There's going to be plenty of damage. If we think about a diversified portfolio, though, being a bit more like a Mack truck, if we hit a light pole at the same speed, there's generally quite a lot less damage to the vehicle and the driver, right? Yeah. Now, we know that one way to protect a share portfolio is to give that real broad diversification.
Yeah, it's so important, Teneale. At the moment, I guess one of the great sayings from Warren Buffett, one of the richest men in the world and a great investor, he said that you don't know who's wearing their bathing trunks until the tide goes out. And in times like this, the tide's gone right out, and there's quite a few investment managers or investments themselves that have been exposed for being less than decent, if you like. They have real risk, and they aren't diversified appropriately and don't have the quality of assets. And some people will be losing money. And our goal today is to show you that your portfolio is so well engineered that the only way that you will lose your capital is if you panic and sell, which was our topic last week. So let's look at our portfolios on growth assets firstly. So for those of you who are in any of our portfolios, you'll have an exposure to Australian shares. So in our Australian share portfolio, we have over 450 Australian companies. Now, that is the top 100 shares in Australia by size, plus value businesses, plus small businesses, and that's also diversified between different sectors: financials, industrials, resources, pharmaceuticals, right across the whole spectrum of the market. So that portfolio is designed to capture the whole market return, plus add a little bit on top over the longer term. Globally, you can see it's a big world out there, so it would be silly of us not to have an exposure outside of our own country. And so our global portfolios pretty well represent the whole developed world equity markets, holding 5,800 shares in our global core large value small funds. And for those who are up the risk spectrum towards our more aggressive portfolios or more growth portfolios, there'll be emerging markets in there, which has 1,800 companies, and that's really targeting Japan, China, India, those sort of markets. Now, folks, that's the whole economy that we've captured in your portfolio. So if that goes broke, if those investments fall over, we're all living in caves. That is the whole world economy as we know it, the whole world of capitalism. So extraordinarily unlikely that's going to happen. And so what we need to do is to be able to ride out the uncertainty in markets until more positivity comes in, which we will get through this, and markets will then start to rise as they have done in the past.
Yeah, definitely, Stephen. I suppose, if we do get resorted to having to live in caves, we've had a little bit of experience being locked in so far.
I'm getting a bit stir crazy myself.
Me too. So we've taken a bit of a look so far about how our diversified portfolios of shares significantly reduce your risk during differing market conditions. But for many of our clients, we know that that's not the whole picture, particularly for those in their retirement years. So we'll dive in a little bit now and have a look at our defensive assets in a portfolio and how we look to bucket the income in particular strategies that way. So on this next slide, we're going to take a bit of a look here on the left-hand side. We're starting to look at how we produce those buckets of income. So the first bucket we look at is being able to provide at-call cash, which will give around, in this case, we're using a real client portfolio example here of 50-50, so 50% growth assets, 50% defensive, $1 million invested, and the individual needs about $65,000 a year. So first of all, in that at-call account, we generally keep around 10% in cash. In this case, that represents about $100,000, which is well and truly enough for the first year worth of living expenses. And certainly also that cash account will get topped up with income distributions from the funds and any other investment income that comes in, meaning that there's no need to draw down on other assets until we've started to deplete down some of that cash. Any short-term goals are typically funded from this area firstly as well. But that's just the piece one. Then if we move out to the right here, we can start to see the other longer-term buckets of income that we have. The mid-term there shows about 20% of the assets being in mid-term fixed interest investments. And the longer dated fixed interest investments you have, the higher level of income return that you'll achieve there. So as with the banks and term deposits, for example, if you give your money to the banks for a longer period, they'll pay you a higher level of interest return. So the same is true here, just on a much more diversified scale. And then you can see in the long term, again, we've got another 2 to 3 years worth of income needs, about 20% or $200,000 there in those long-term fixed interest buckets as well. So here we can see that the first 5 to 7 years worth of income needs are met purely from the cash and defensive assets in a portfolio. And as Steve said, that means that we don't need to go drawing from growth assets in periods like this where they're depressed, and we can wait until the time comes to do a rebalance of a portfolio.
Yeah, that's great, Teneale. It is really important to understand that in the current environment that we found ourselves pretty well following the GFC, interest rates have been incredibly low. So it's been a very, very challenging market to produce higher returns in the fixed interest market. And we've seen that in term deposits in the banks. And so, you're very lucky to get 2% on a term deposit, maybe 2.5%. So it's really important to make sure you've got these high quality mid and long-term fixed interest investments to push that income stream along. And the second point I'd make here is that all of those investments, right through the GFC and right through the time we're seeing now, the unit prices are moving, or the at call doesn't move at all. Short term hasn't moved a bit. The longer term moves a little bit, but not quite a lot. So you've got real stability in the capital in those particular investments. So if you need liquidity, if someone gets sick or something happens and you need to take a lump sum out, while share markets are down, we want to make sure that we can access some capital. So the cash account's number one, the short term's number two, and the longer term's number three. And from our experience, having many clients go through the GFC, I've seen the majority of my clients be able to draw their income right throughout that whole period, take out lump sums when they've needed it, and still to this day, a lot of those clients have not even touched their shares. So even though they were down 30% in the GFC, they still haven't touched them. And of course, up until recently, they were at record highs. So that's our bucketing strategy. When you put those two things together, the reason why you have shares in a portfolio, whether it's 30%, 50 or 70, is to grow that income stream. The whole purpose of investing is to grow income. It's why you buy a business, to get income and hopefully grow it. So it's important to have some growth assets in a portfolio so that your income can beat inflation, because that's definitely going to kill you. What's your thoughts on that, Teneale?
Yes, well, we know that in our accumulating years, certainly volatility is the thing that we want to try and stop, and we can do that as much as possible by broad diversification. And then in retirement, it's all about controlling for that cost of living and inflation. It certainly can be the hardest hurdle, I suppose. And you're absolutely right. With a really well-engineered portfolio, we'll be able to get through these events and continue on and not have to go back to work.
Fabulous. Well, folks, I hope you've taken something out of that presentation. We do have some questions, so the good thing is I've got them in front of me, so I'm going to ask the curly ones, pass them over to Teneale. So one of our longer term clients has said, it may get addressed, however, in these very uncertain times, do we follow the usual rebalancing parameters or do they change?
Yeah, and I think this is a really good question, and it's an area that we look at quite often because we do know that rebalancing a portfolio is important, and next week's sessions will all be designed around that that premise as well, I believe, Steve. Now, we have an investment committee that meets, and our asset allocations are designed on tolerance levels. And at the moment, our tolerance levels are 5% of each of the asset classes that we're actually managing. So what we have seen in these certainly very volatile times is that as quickly as markets are dropping, we're also seeing rebounds happen, which has meant in 9 times out of 10, we're not getting outside of those tolerance zones in any particular period of time. So yes, we are looking to do rebalances where they are necessary. And typically what we're finding at the moment is that because the growth assets will be the area that has had some negative growth in a period, typically that will come in the sense of the defensive assets, so the fixed interest being overweighted. And therefore we know that the theory is that we take from those overweight assets and get those back into the growth assets, so that when we do have that recovery, we'll be in the right position to take some of that cream as well. So yes, we are looking at rebalancing, but we do have some tolerances that we look at firstly.
Yeah, it's a great question, Mark. We appreciate that. Definitely for accumulators, we're looking to rebalance with cash. So those who are in a position to invest more capital, that's how we generally like to rebalance our growth portfolios. In superannuation, contributions are going in, so we've got the ability to rebalance that way. And for you, our retirees, as your cash portions rise, and Australian equities, particularly at the moment, have fallen the most in our portfolios, then you have the ability to use some of that cash to rebalance, and we're definitely doing that as those tolerances get ticked. Now the next one I'll answer, Teneale.
No worries. So the question, Steve, is do our managers actively sell and rebuy during these volatile periods?
Yeah, another great question. I guess it comes down to the philosophy of the fund managers we use. First of all, we believe that the foundation of successful investing should be low cost and should capture markets. So if you think about index funds for a starting point, indexing is a buy and hold approach. You're buying the index and you're holding it for the long term. And so there should be very little trading. The issue with a index manager, which we don't use, other than for our smaller clients and our property portfolios, as companies are dropping out of the top 100 shares or top 300 shares, they have to be sold and others have to be bought. So there is trading on the edges. The fund managers that we use generally for our clients take an asset class approach. So they're buying all of the shares that make up the risk and return factors we're looking for, and there's very little trading on the edges. And that's how you want it. You don't want people making big bets or changing portfolios. Just like we said last week, you should stay seated. Active fund managers who are buying and selling are doing exactly the opposite of what everything in the academic world says that you shouldn't do. So very little trading during these times. We also had a little bit of feedback. One of our charts was wrong. So on our 30/70 portfolio, underneath those numbers were twisted around. I'll get that fixed. Thank you for that. And as there are no more questions, thank you for attending. Next week, we'll be doing 2 sessions, and that's going to be on Wednesday. We'll send invitations out. And we're going to be talking about the time it has taken, going back and looking at all the major falls in equity markets over the last 115 years, and looking at when they started, what their lowest point was, and how long it took them to get above their previous high. And we'll look at numerous of those, so we get a bit of a feeling on history and see how long it has taken for your investments to get back to where they were, and then what happened the next decade onwards. So I think that'll be really important, and we'll touch on rebalancing as well, Mark, and talk about the importance of buying low and selling high.
Thank
So
you
I'll
so
let
much
you
for
wrap up.
attending. Yeah, thank you so much for attending, everyone. Any feedback that you'd like to leave, please do so. There's a bit of a survey there. We really appreciate your coming along. And if you do have any questions for your own advisor, please feel free to put them out to us. Stay safe, and we'll speak to you next week.
Yeah, stay safe. Thank you.